available when it comes to businessmen, but not to the professional or the principal or the salaried employees. And therefore, you have to be very focused that yes, out of whatever I am getting, my 10, 20 and 30% are going definitely. And therefore, best planning for you is investment and your retirement plans. You must plan appropriately for your retirement, what you would be getting after, I don't know, you retire at 65? 62. So, and nowadays average age is now 82. So 20 years after retirement, you need to live comfortably, if not luxuriously. And if that planning is not appropriately made, as you all know, situation may be not as comfortable as you would have envisaged. So invariably invest full amount of 100,000 rupees that is available in section 80C, 80CC, 80CCC. Now one more amendment has come from 1st April 2010 up to 31st March 11, infrastructure bond, that 20,000 if you invest, that also will be additionally available. Medical premium is also, as I said, has been increased. So try to see that you pay full medical insurance premium and get the maximum benefit. Because for you, the medical reimbursement could be for you and your wife or for the entire family, I don't know. But it's not for the entire family. This kind of medical insurance premiums cover the chances of any unforeseen event to the family members, dependent children, and insurance company will be paying that. So you must pay full insurance premium on that also. So far as PPF is concerned, you would be getting deduction of your PF that is being available and GPF what you are saying. But it will be always advisable to pay premium in the name of your wife or in the name of your children or child if you want, so unless he is having taxable income of his own. Advantage is it is always tax free. You are always non-attachable. I know no principal would be incurring a debt by which chances of outside agency coming and attaching PPF account would come, but still that is safest of the safe. Idea is besides 15 years you can continue for next 5 years period also. So till you retire at the age of 62 and your pension is not sufficient to take care of, you can start withdrawing it. Now here is a red line again, particularly for professionals. This new code coming, direct tax code coming, is coming out with the concept of EET, that is exempt tax. Exemption when you deposit, exempt when every year the income is available, but tax when you withdraw it. So this withdrawal is required to be also appropriately planned, by which your income is below taxable limit or below that first 5 lakh slab. So you don't pay more than 10%. So that is very important. So you should also work out your insurance plan, PPF investment and withdrawal thereof, by which if you are now at the age of 50, 55, you must start calculation. Your clock must begin at 62, now 61, now 60, 59. And that's how you should work out your retirement plans. In many times you must be reading in the newspaper, if you invest this much, and then after 18 years you will get so many things and so much benefit and so much capital. But question always remains that after your salary, after your tax, after your deduction of GPF, after the deduction of your loan, what is available with you net? You need to incur certain household expenditure also. Now for all respected professionals, I would strongly suggest after some age when you have your dependent children start earning income or your other family members start earning income, reduce your household expenses withdrawal and see that other family members start contributing in the household expenses. So automatically your savings would be more. If your savings is more, notwithstanding the benefit of 80CC or 80C, you must invest in PPF and your insurance larger way, and that would in turn allow you to get regular income once you cross 70, 75, 80, 85, whatever is that maximum age. So this is very important. Your son should feel that yes, now your son or son's wife or grandson, whatever the grandchildren, they also would feel that yes, I am part of the family and still the HUF lives together. That concept should be done. If you are a family of more than one person, that is husband, wife and a son or a daughter, the creation for tax purpose, it is already under the law in Hindu unwed family. HUF is also advisable. I know under the code of ethics, profession may not and might not be allowed to do any business, but Hindu unwed family is a separate taxable entity. Again up to 1,60,000 no tax and then same slab. Now in that Hindu unwed family, you can plan out certain income. You can do the income from share transactions. which are maybe in the nature of short-term capital gain or maybe in the name of the business. Even if it is a business, up to 1,60,000, you are not going to pay any tax. So a separate entity is available to you, and if you have spare time, sometime maybe in the college also or sometime in the at home, you can keep on spending your time on investment instead of investing straight away in the mutual fund, where your funds are being taken care of by an outsider and handsome fees are charged. So that generation of income in your Hindu unwed family is only option available to transfer some of your income, to transfer some of your activities and intelligence into another stature instead of your own name. You can do it in the name of your wife also, if she is reasonably literate and understanding what she is doing, operating bank accounts and all that. But if that limit is also exhausted, as I said, by rent or by other income, and if she has her own stridhan, then you can have this third entity, which you should very gracefully do. Now comes the question of what areas you will be get and what would be the tax impact. There is a specific provision in section under Income Tax Act, section 89, subsection 1, that if any employee receives an arrear from his employers, then if in year in which he receives such arrears, increases his taxable income and consequential income tax quite high, then it can be spread over a period of 3 years. How the calculation to be done is provided under Rule 21A of the income tax rules. So I would strongly suggest, though Saurabh has very clearly clarified, that you are going to receive the checks only on or after 1st April 2010. But perchance if the clerk is very efficient or the department is efficient and they are ready with that, see to it that you do not deposit those checks before 1st April 2010. So receipt of arrears will be always considered from 1/4/2010 to 31st March 11, that is 10/11, assessment year 11/12. So all these benefits which are now introduced in the budget will be available to you, one, and then your arrears will be divided over a period of 3 years. So your income for 10/11, based on what is stated, is say going to be 9 lakhs, and you are going to receive the arrears of 9 lakhs. Your income would be 18 lakhs. So anything in excess of 8 lakhs, the 10 lakh will be subject to straight away 30% taxation. But if you are applying under Rule 21A, so as to take the benefit of spread over under section 89, it can be spread over the last 3 years. And as I understand, in last 3 years your income was not as high as this. So many of you would be falling in the second category of slab, that is at the 20% slab. So you have to do this exercise with your chartered accountant or whosoever you have filed the return of income. Otherwise, Saurabh's service will always be available. And in turn, I am assuring you that I will give you the computations and calculations of whatsoever principle or whosoever principle is there. But that calculation exercise has to be done. And then you have to work out that yes, whether spread over for the 3 years is available or not. And if that is available, I would strongly suggest you do it. There are no cost involved, no additional fees or additional expenditure also involved in the income tax. And just like you are getting your return filed and refunds received, same way these assessments will also be done subject to certain inquiries. So I would suggest that yes, please go ahead and do that. That is, I think, so far as the individual returns are concerned, there is not much is mentioned. But as I said, you try to find out that yes, what are various other savings and sources that are available to you subject to the 6 deductions which are non-taxable or taxable subject to various limits and exemptions. You should plan out. Now comes the question of your institution which you are heading as a principal. Maybe there are trustees who would be more concerned to see how their trust, charitable trust or society, is not paying tax. But as a principal, I would say that yes, most of the colleges are run by the charitable trust, and therefore they are enjoying the exemption under section 11. The condition in section 11 is that earlier 75, now 85% of the income must be spent. Now I understand most of the colleges are running in the deficit, so you must be spending 100 or 100% plus. But then there are areas by which, subject to the UGC and university rules, if you are in a position to receive more fees or more contribution or more donation from the students or from other entities or other persons, please receive that.
If the college gets the grant from UGC, whether it is considered as an income of the...
Yeah, grant is certainly, because grant is with a direction that it must be spent for the purpose for which it is received. and if that grant is not spent,